This newspaper article from the Helsinki Times is pretty characteristic of the sort of commentary you'll see about Nokia. Whatever happened to Nokia? The rise and decline of a giant. Well, the company is hardly a one-trick pony because they were founded in 1865 originally as a pulp mill, and they went on to do electrical generation and then rubber production and respirators and radios and finally the ubiquitous Nokia phone, at least back then. But that didn't persist for very long. Here you can see where they had upwards of 50% market share for smartphones, though that fell to around 40% before falling off a cliff about 13 years ago when things went pear-shaped. Now, there's probably a dozen case studies out there that MBAs can work on now and talk about what happened to the company, but it's clear they lost their edge. And that's characteristic of a lot of tech companies over the years. Hewlett-Packard, I used to work there, their R&D department in the late 90s, and I can recall we were all quite excited talking about rumors that they were actually 3D printing things. And Hewlett-Packard was known for their inkjet printers, and now I don't know what they're known for, but it sure isn't 3D printing. So they failed to capture that exciting market, though, to be honest, 3D printing didn't do much, or hasn't done much so far. Then there's IBM. They've tried to capture just about everything, and they haven't been able to make that work. You have BlackBerry. That device they had enjoyed some success for a while, and now I guess they're an up-and-comer for cybersecurity and IoT and failing in both. Then you have Intel. They've pretty much had their asses handed to them by NVIDIA because they probably became lax in their leadership position. So once a company loses its competitive edge, it's very hard to get that mojo back. As investors, we prefer companies that aren't trying to turn things around. And if you look at Nokia's latest quarterly earnings call, this is the first slide. And I came across this quote here from a business school that said their bureaucratic organizational structure made it difficult for Nokia to make quick decisions and move rapidly to embrace novel strategies. So here they are 13 years after failing, trying to fix that, and you see they talk about accelerate strategy execution through operational autonomy. And this slide looks at how they're moving from this complex matrix organization to more direct reporting and interfaces. It has management consultancies written all over it, and it's what happens when a company tries to fix itself after many years of failing. And how this is supposed to work is that it's natural for tech companies to lose their edge. What they're supposed to do is, according to this growth share matrix, use their cash cows. These are low growth areas where they have high market share, and they're raking in all this money. They're using that money then to fund other areas that are perhaps high growth, low market share. So when you look at what Nokia says they do, I like this statement in their 2022 report. It says, Nokia has 4 business groups, with each business group aiming to become a technology and market leader. See, that's the problem. They should already have a leadership position in at least one of these segments and be using that to fuel the others. But when you look here at network infrastructure, mobile networks, so those are the areas they operate in most heavily. And then you have cloud and network services, and Nokia Technologies, which is just, that's the definition of a cash cow right there. There's no gross margin. It's just pure profit, and that's their technology licensing and royalties and whatnot. But you can see from this slide here that they're a jack of all trades, master of none. Their network infrastructure equipment segment, that's going to face very stiff competition from China. And while everything sort of looks good here on the tin in terms of some growth across those segments, the problem is that when you take a more holistic look at the company, they aren't growing. You can see here over the past, 7 years or so, that revenues have sort of flatlined, and they always seem to be on the cusp of turning things around, according to management. Perhaps they are on the cusp, but we also noted their quarterly revenues here are quite seasonal. When we look at their last quarter, and just a cursory look at a stock price chart shows that they were hurt as a result of this quarter, investors punished them a bit. They say here the outlook has been maintained despite weak operator spending weighing on Q3, and then they're down. You can see the chart in the upper right here, down 15% year on year in this quarter. And over on the left there, you can see how their gross margin and operating margins are being compressed. You don't want to be going into bad times with these weakening metrics. That's what appears to be happening here. And you can see the charts on the lower right there show their rolling gross margin and operating margins. And you notice how they've delineated those ex-tech. That's to remove that gross margin of 100% and paint a more accurate picture of what these metrics look like. So when we look at this on a segment per segment level here, you could see network infrastructure, mobile networks, cloud, and of course Nokia Technologies. The gross margins, and if we just look at, let's say, X Technologies, because these are the segments that are more depict the actual business, the gross margins are upwards of 36%, and then operating margins are quite low across the board there. They talk about how it's typical for their industry to have sales driven by multi-year customer agreements with a limited number of significant customers. I think they have one customer that's 10% or more of revenues consistently, but that's sort of a problem for a company this size to have that customer concentration risk. And when you look at who they're selling product to, it's mainly what they refer to as communication service providers, or CSPs, so telecom carriers, content providers, cable service, satellite broadcasting, and whatnot. When you look at why they ran into growth problems this last quarter, you could see the impact of having geographical diversification, which is great, but it didn't help them out enough. So you could see that strong growth they had in India, where they're doing some work there, but then where the majority of their revenues is coming from, there in North America, they got hit pretty hard. So that growth they enjoyed in India wasn't enough to offset their declines elsewhere. Now, if we take a step back here, macroeconomic headwinds are affecting all companies across all industries right now. We observe that pretty consistently. The depressed share price allows us to purchase a company at a discount. The question is this a quality company that we want to be adding? And as I believe it was Buffett said, it's better to purchase a great company at a fair price than a fair company at a great price. This is a fair company. It's not a great company. Maybe it was at some time, but it isn't now. What you're hoping for here as an investor in Nokia is that they can start growing revenues and or increasing profitability. And you may look at their 3% yield and think that's attractive, but don't fall for that old trap. What yield means for Nokia is very little. So take a look at this chart here. It shows the dividend payments over time. So there in 2014 or so, it looks like they had a reasonable dividend that went up the following year significantly, and then it dropped 34%, then it went up, then it dropped 40%, then it just went away for 2 years, and then suddenly it's back. This is random income that you can't count on, and it's a perfect example of when yield means nothing because you're unsure of whether or not it's going to continue. And when you look at their free cash flows chart here, they had a negative free cash flow. They say that net working capital was primarily responsible for that. Indeed, that's the case, but here you can see how the dividend and share repurchases, of course, it's a good time for them to be repurchasing shares, but how consistently are they going to be able to pay that dividend and repurchase shares when they're starting to run into problems not having positive free cash flows because all the metrics are moving in the wrong direction. And then when you look at the TAMs, they actually calculate these TAMs. It appears every quarter they provide them, which is rather interesting. But you can't talk about dabbling in 5G and IoT and cloud and AI, and they drop all the buzzwords, and then not have growing revenues. That's because these themes are all growing on their own. And if you're not growing revenues, that means you're not capturing opportunity there, and someone else is. So when we think about investing, it's really growth versus value. This is a spectrum on which all stocks fit. And on one side, you have disruptive technology, which is growth with the highest volatility. And that's where we like to place some bets. And then the other side of the spectrum, you have dividend growth, which we see as value of the highest measure. Our strategy rides both sides of that spectrum, but is weighed very heavily towards value. The majority of our money sits in dividend growth investing. Companies that sit in the middle of this spectrum, those are the least interesting to us. So is Nokia value or growth or neither? Well, when we try to understand Nokia investors, we can certainly understand the love for Finnish innovation. I've spent time over there interviewing Finnish technology companies, and we certainly love the way that the Finns operate, and we have quite a few as readers and subscribers. I think that the lingering brand recognition is what's attracting investors who are trying to find value at these depressed prices. But the way that we see it, Nokia doesn't offer growth or value in respect to where they sit today. And it's really reminiscent of another leader to laggard example, which is Cisco. They're also a company that's never really managed to resurrect itself from its loss of leadership in the heydays of the .com times. So I've put up this other video here that you might be interested in watching. Thanks so much for taking the time to watch this today.